Welcome back, everybody. It's good to have you. We are already past the halfway mark for the year 2022. And so this is an important milestone. I want to take a look at the big picture today. A lot has changed. A lot has happened in the real estate market in Milwaukee in the last 6 months. So that's a good opportunity to zoom out a little bit, take a look at the big picture and see what's going on. We have looming recession concerns. We have rising interest rates. We hear about prices going up every day in the news, about inflation. So we're going to take a look at that and see how it impacts the local real estate market. In the second half of the video, I also want to take a look at what might be in store for us for the second half of the year. What can we expect for the second half of the year? And most importantly, what does that mean for you and for your personal strategy if you're thinking about moving in the next 12 months? But as always, let's get started with the latest numbers straight out of MLS. And very much as expected, we have seen inventory going up a little bit further, plus 23% in June, more homes on the market. But with that, we have sold about 14% less than last year. So that is the impact of the combination of higher interest rates, the market softening a little bit, and still not enough inventory. People cannot find what they're looking for. So that is really, inventory remains the bottleneck on the sales. But market is still very fast paced. Time on market, median is still 5 days. So your typical listing will go on the market on Thursday or on Friday and will usually be sold over the weekend, at least if it's a good house, if it's in good condition, and if it's priced appropriately. We're seeing more and more listings that are sitting on the market past 10 days. And we are also seeing more price reductions. But for the most part, still a very fast-paced market. Median price is up now to $311,000. That's up 12.68%. So earlier this year, I was speculating if we have already seen the peak of the market in May. So these are the listings that went under contract in May, very much at the peak time, and closed in June. So now that's coming down. We have the sold data now, and that resulted in the new high for this year, $311,000. That's about 12.5% more than June last year. And for a little bit more context, I have some big picture numbers here so you get an idea what does that mean in the historical context. And I've chosen here June of 2019 because that was just before COVID. Then I have also June 2015 because that's always my benchmark year because that was a fairly neutral and balanced market. And then we had, as a bad example, if you will, we had June 2008, which was the worst market that we have seen probably in my lifetime. So you can see inventory was always a lot higher than it is now. And that really gives you a sense for how low inventory is with about 3,600 units. We had about 6,000 units just before COVID, and we had 13,000 in a balanced market. And in the worst market that we've seen back in 2008, it was 18,000. If you go further back in time, you will find that we usually always have about 10, 12, 13,000 units on the market. So this was really the highest here. As far as sales, that's relatively stable, usually around 3,000 units, even 2005, 2002, when you go back in time. So the all-time low really was June of 2008 with just around 2,100 units. And also reflected here in days on market. So of course it took a lot longer to sell a house. And you can also see here in the prices. So all the way from 2008 to now, prices have almost doubled. So if you're a homeowner, that's great news because that means your equity has gone up, your net worth has gone up as your house continues to appreciate in value. If you are on the buying side, of course, that is not such great news because that really impacts your affordability and how much house you can buy. Let's take a look what's going on with affordability. I have here the index for Wisconsin. So an affordability index of 100 means that a median income will buy exactly one median house. And you can see here affordability has gone down a lot in the last 12 months. We are seeing about a 30% drop here from 182 to 127. We're still in the green, so affordability is still good in Wisconsin, but this is a significant drop in the last 12 months. And of course, that is attributed to rising home prices and also massively rising interest rates. So that, of course, makes buying a home a lot more expensive than it was a year ago. We're still doing pretty good compared to the national average. So you probably know this. A lot of areas in the US have seen home prices go up much, much faster than we have seen it in Wisconsin. They were already a lot higher on the East Coast and on the West Coast, and they have gone up on a much faster pace than we have here. So affordability is not good. Nationally, we were in May at about 102. And so I think we might drop actually nationally below 100. And that means there are a lot of states, California, out East Coast, West Coast, where the affordability index is in the deep red. So we might see something there in the 70 or in the 80 range. So nationally speaking, we are doing a lot better. And you can also see this here in buyer traffic, as always, data from showing time. We have very precise data here, and I'm contrasting here two charts. The top one is North America, and this one is Wisconsin. And the two blue lines are the last 2 years. The orange line is the year where we're currently. And you see here for North America, we are dropping off significantly below 2021 and below 2022. In Wisconsin, the three lines are running much, much tighter, and we are basically on the same level here in 2022 as we were last year in 2021, almost exactly the same. And we will see how we keep going from here, but that is basically attributed to the lower home prices that we have in Wisconsin. Affordability is still good, so we are not as much impacted from the slowdown as the rest of the country is. Speaking of the rest of the country, let's take a look at the change in inventory. So as of June, we had a national increase of inventory of 19.9%. So there is significantly more inventory on the market. If you're currently hooked up with an MLS portal and you're looking online, then you have noticed that we have more inventory to choose from. Wisconsin is actually doing pretty good here. We have an increase of 16.1%, which is an indication that our market is still stronger than the rest of the country. You can see here inventory is going up very fast here in the markets on the west, and also in the markets on the south. They're seeing 20% plus increases here in inventory. So we still have a lot of buyer demand, and that keeps inventory relatively low compared to the rest of the country. Next, let's talk about inflation, because that has a big impact on real estate prices, in fact, on all hard asset classes. And if you are subscribing to my channel, you've heard me talk about inflation for the last 2 years. So we are now in the midst of it, in fact, a little over a year, and we're now at 9.1%. A lot of people are thinking of inflation that everything is getting more expensive, right? Prices are going up, gas is more expensive. And another way of thinking about inflation is really that the dollar or the currency is devaluating. So we've printed too many dollars in order to keep the economy alive during COVID, and now we have too many dollars in circulation, which means that the value of the average dollar is coming down. That means if you want to buy something, you have to bring now about 9.1% more dollars to the table than the same goods or services would have cost you a year ago. So I think we will stay in inflation for quite a while longer. Historically, it's always been 2 or 3 years. The Fed is working really hard to get that down. They just announced another tightening of the monetary policy. They increased the Fed funding rate by another 0.75%. And that is starting to show some impact, but it will continue to also impact the housing market, because that means you have to bring more dollars to buy the same house as you have bought a year ago. And as long as we have inflation, we will also see the upward pressure from that side on home prices. So if you are a homeowner, then you actually stand to benefit on that side from inflation, because inflation doesn't really discriminate as much as it erodes your savings, which is something that we're all dreading. It also erodes your outstanding principal on your fixed rate mortgage. So as the dollar continues to devalue, measured in your updated net earning power, the principal that you owe on the house is going down. Meanwhile, the home value is going up. So you really stand to benefit from inflation. But it has a big impact on home prices. We will see how long we're going to be into it, and if we have already reached the peak. Fed is working hard, and we're already seeing a little bit of an impact. For example, here I have oil prices. So as the demand is dimming, we have seen that in previous years as well. Oil price, just as real estate prices, are really driven by supply and demand. And with the higher prices, of course, now people are trying to save fuel, save a few trips. And with that, the oil price is coming down. The first time we're seeing now less than $100. You can see here the last weeks in decline. So that's a little bit of positive news that makes me think that maybe we have already seen kind of the top of the inflation, but of course it's too early to say. Here's a look at the job market, and a lot of people are talking about an upcoming recession. The first quarter we actually had negative GDP. For the second quarter we don't have numbers yet. They will come out, I believe, on July 28th. And they are forecasted to be slightly positive. In order to be on a recession, we need to have 2 consecutive quarters with negative GDP. So we're not there, and it looks like we may not be there in the second quarter. But usually what you associate with the recession is layoffs and everybody's losing their job. So if we are headed into a recession, I still think we are, because the Fed needs to cool down the economy. Then this is a very odd one, a very different one, because we are not seeing layoffs. Just the opposite. We have currently about 5.9 million people unemployed and about twice as many job openings, 11.3 million job openings. So if everybody who is unemployed would accept one of these jobs tomorrow, we would still be left with over 5 million job openings. So a super robust job marketing. You have it a comparison over the last 3 years. And job openings remain still very, very strong. So this is really odd for a recession. And that is one thing, income and employment, that has also an impact on the housing market, of course. So, that is going to be a very important factor going forward. But for right now, this looks really positive for the real estate market. Now, here's another piece to the puzzle. When you look at a market altogether, we also have to look at exchange rate. I actually just got back from a little vacation in Europe. I went to Austria, see my family, and spent some time in Italy as well. And it was nice because for the first time I was able to exchange $100 to 100 euros. So normally I needed to bring $120 to get 100 euros. So if you're going overseas, right now is a good time, because it makes your vacation over there a little bit more affordable. It also helps with import. So everything that is built and manufactured over there in Europe that we're importing, because the dollar is gaining strength, that is part of the Fed raising the interest rate. So more investors are seeking the US dollar zone. So that's benefiting us with our imports. Of course, that is making inflation tougher for the Europeans, because they're suffering from inflation just as much as we do over here. But on our end, it really benefits us. By the way, 2 other big issues over there in Europe are gas and energy prices. So gas is about $8 to $9 per gallon. So they have much, much higher gas prices that we have here. They're suffering from that. And they also have increasing home values and the real estate shortage. So these issues are not unique to the US. We also have the exact same thing in Europe. But the gain in value in the dollar is another good indication that what the Fed is doing slowly starts to work a little bit. Next, let's take a look at interest rates. We are currently at 5.51 for a 30-year fixed, theoretically at least. So that's with perfect credit and perfect debt to income ratio. Practically speaking, we're seeing a lot of 30-year fixed right now in the high 5s, in the low 6s. That would be a typical rate. The good news is that we are not increasing anymore as we used to. In fact, we have come down a little bit, and it looks like we are going sideways now. There's a lot of experts that seem to think that we have seen the worst in terms of mortgage rates. I'm not ready to totally subscribe to that, but you can see here I have the latest forecasts and the averages of all 4 of them on the right side, all the way on the bottom right. You can see to the third quarter of next year, and the consensus is that we are seeing mortgage rates that are stabilizing and or coming down. So a lot of people are currently financing homes with adjustable rate mortgages. A very different product, by the way, than we have seen back in 2007, 2008, getting us in trouble. But we see over half of financing done with an adjustable rate mortgage. And it seems like there is a decent chance that when they're refinancing, at some point in the next 5 years that there might be at a same or a lower rate. And that has to do with a number of factors. Recession is a big one. I have here a survey from the Wall Street Journal, and 3/4 of the global CEOs say that we are in a recession now, or that we will be in one in the next 12 or 18 months. So if we're not already in a recession, then they are planning for it and they're seeing it on the horizon. Businesses are super solid right now. The US businesses are sitting on $4 trillion of cash. Earnings are very good, much better than they have historically been. So businesses are in a very strong position. And the reason I'm mentioning this is because it does not seem very likely right now that they will stop hiring, because they really need people. They have so many open positions. So it does not seem like at the moment that we are seeing the typical response that normally you get from CEOs. If they're worried about recession, then they start letting people go. That's not what is being reported at the moment. Now let's take a look a little bit into how mortgage rates correlate with recessions in the past. And this is basically the argument why experts are thinking that we might see lower rates on the horizon. Like I said, I'm not 100% convinced if I'm on board with that yet, but the argument is solid. What you see here is the 30-year fixed rate mortgages over the last 40 years. So we had a peak here of 18% back in the early 1980s, and then over the decades they have come down. And the gray shaded areas, those are the recessions. And you can see every single time we were in a recession, mortgage rates came down. The last one here was the COVID recession from 3.8 to 2.8%. Here the Great Recession, 2007 to 2009, 1.5 years, from 6% to 4.9%. So on average, we have seen about 1.8% drop in rates during recessions. So if this turns out to be correct and we're indeed seeing mortgage rates coming down, of course, that will give additional impulses to the real estate market again. We will have buyers that have been priced out of the market come back. It helps with affordability. It helps with purchase power of buyers. So we're going to see more buyers come back into the market. And of course, we still haven't resolved the inventory problem. So the market is currently, in my opinion, on the way of getting healthier by slowing down a little bit. We needed to lose a little bit of that crazy, insane pace that we've seen the last 2 years. We're getting healthier. If rates are coming down, then of course that will increase the pace again. But on the other hand, the housing market is such an important part of the US GDP, of the US economy, that it is undoubtedly necessary for a recovery of the GDP. So we'll keep an eye on it. And that gets me to the big question that everybody has on their mind who is thinking about buying a home: timing. Should I be buying a home right now? And I'm trying to give some answers to that. Of course, your personal circumstances are going to be your number one determining factor. But there's also other things to consider, most importantly, some data. And a lot of people, of course, are reading the news. And like a friend of mine likes to say, news headlines are doing more to terrify than to clarify. And I think this is a typical example, because everybody is reading about the housing market slowing down and kind of thinking, okay, that means home prices are coming down. But that is actually not the case, because decelerating home price appreciation does not mean home prices are coming down. It just means that the rate of which home prices are going up, partially driven by inflation, that is slowing down. And that's a very healthy, a very good thing, in my opinion, after what we have seen the last 1 to 2 years. So here's a slide that you've seen last month, but it's so important that I want to bring it back, because if your friends or family are telling you, well, if a recession is on the horizon, that means home prices are going to crash, the real estate market is going to crash, take a look at the historic data. Historically, real estate markets have done very, very well during recessions. Prices have usually continued to go up a little bit. The only famous exception is 2008, which was really a mortgage crisis that turned into a recession and not the other way around. What's different this time is there's two things. Number one, we have an upside down situation with inventory. Back then, we had a lot of inventory and vacant homes. Now we are tight on inventory. We have a lot of buyers. And we also have a super, super strong job market. So people are employed. And that's the reason why we do not have a housing market crash anywhere on the radar. That's the one thing that all the experts are totally agreeing on. We don't know exactly what the numbers are going to be, but there's literally nobody that is concerned about a housing market crash. So here I have the latest forecast numbers. This is the June update of the home price appreciation forecast for the remainder of the year. It's been reduced a little bit. And you can see here the average of all the experts that we're including here is down to 8.5% for the entire US. So that's reduced, but you can see some of them are still very, very optimistic. The Mortgage Banker Association a little bit less. Here's the estimate for the 5-year price performance of the real estate market in the US. So 2022, the expectation is that we're going to finishing it in a very strong way. This is a panel of 100 economists that get surveyed every quarter. And you can see they're optimistic for the next following 4 years that home prices are going to continue to go up. They're just bringing it down to historically more appropriate levels of about 4% a year. I think inflation will play a big role into that. So if we continue to see high levels of inflation, I would not be surprised if we see those numbers come back a little bit higher. Now, what does that mean for you? And in the beginning of the video, I promised to break it down a little bit. If you're thinking about buying or selling a home in the next year or so, what should you be considering? So the first thing that I really want to drive home, the Milwaukee real estate market is very seasonal. And I have not made this point strong enough last year in my YouTube videos because a lot of our clients have been caught a little bit by surprise in the first quarter, what was happening. And that's entirely predictable. So I'll walk you through what is going to happen here just from a typical seasonality point of view. Of course, I don't have a crystal ball. I can't tell you what's going to happen in big picture economy in the next 6 months. But we know from history, we always have the same seasonal market changes in the Milwaukee real estate market. And the seasonality that we have, especially our winter season, the cold season, and the holiday season, that has a big impact on inventory. And with inventory levels as low as they currently are, any small change in inventory, of course, has a big impact on your success. So let's take a look what that means for you if you are a seller. So if right now we are in a little bit still of the typical summer lull that we usually have after the 4th of July, people are up north, people are in vacation mode. So things are a little bit slower. Now, of course, we are in a super fast-paced market, so you all have to put it into that context. But from a typical seasonality point of view, we have seen activity drop off after June, and we are a little bit now in a summer slowdown. That will pick up again late August and September as kids are going back to school. We are going to see a pickup in activity. And that is, historically speaking, every year a good time to list. So we see the highest bump in the spring market, and then we see a second wave coming, usually end of August and then through September. And then, as we're going through the season, of course, we're expecting this year also the seasonal slowdown as everybody's mind starts shifting more towards holiday season. So real estate really slows down at around Thanksgiving, and it remains slow all the way through New Year. And then we have Q1, and that is the biggest misunderstanding that we have on the seller side. Sellers always want to wait until spring, until the grass is green and the flowers are out. And that is in many cases the biggest mistake that you can make, because Q1 is so low on inventory that it always presents a really good opportunity for sellers, because if you put your house on the market, you might be the only one. I can give you a number of good examples. I remember this year in January, we were house hunting in Wauwatosa, and there was exactly one house in that price range that came on the market. And of course, we didn't get it, and there were like 25 cars parked there. Next week, a similar house came on the market. And from those 25 cars that we've seen the week before, 24 showed up at that open house again, because there was just only one house and way too many people trying to buy it. So if you're a seller, that is a great opportunity. This was not specific for Wauwatosa. We see that everywhere in the Milwaukee area. So what does that mean for buyers? More inventory and less competition ahead. So if you're a buyer, you are benefiting from that situation now. Don't count on prices coming down. That is, best I can tell you, not going to happen. But we are seeing fewer competitive offers. So when we're writing today an offer in a competitive situation, there might be 3 or 4 or 5 offers. And 6 months ago, we may have had to compete against 10, 15 or 25 other offers. So the level of competition is coming down. That makes it easier. Q3 offers typically a lot of opportunities, because we're going to see a little bit of an influx of more listings just from a seasonality point of view. So there's more choices, which means that the buyers are spread out over more properties. Less competition makes it a little bit easier to find a home that is right for you and get a good deal. And then new listings will slow down in Q4. So that's the concern here, that if you haven't found a house by Thanksgiving, you will not have many new choices coming on the market. So there's not that many listings. So that means you have to be patient until the spring market. And with that, flip side of the sellers, Q1 is always the worst time to buy a house, because there's so little inventory, as I just said, and it's really not fun to be on the buyer side. Of course, if your personal circumstances are in this way that you need to buy a house in that period, we make it happen every year, and we will next year. But if you can plan ahead, and if you can be strategic, and you have the luxury to time the market, and you're on the buying side, I would try to avoid January and February. It gets a little better in March, but January and February are usually really tough. So plan ahead, and if I can help you with that, feel free to reach out to me. You can send me an email, you can call me if you want to go on my website, and you can schedule a quick Zoom call with me. You have access to my calendar there. Just put it on my schedule, and we can discuss your goals and your circumstances, and make a strategy that works for you and that implements or includes all these things. So here's the crystal ball for what we can expect for the next few weeks for Milwaukee. So there are going to be more homes to choose from. I'm expecting for July another maybe 15 to 25% increase in inventory. And we're also going to see more listings that are over 10 days on market. And that means you actually have the possibility to negotiate, because as you know, if stuff goes on the first weekend, that means multiple offers, usually 5 to 10% over asking price. Nothing has changed there. But there is more and more listings that we're seeing that are not selling on the first weekend. And then it's a completely different dynamic. If you're the only offer that is placed on that property, then we may not have to go over asking price. You may even have the possibility to negotiate the price down a little bit. 5-star deals will remain to be very competitive with multiple offers going way over asking, so there's no change there. But there are opportunities to be found in between. And I think the next few weeks will likely present the best buying opportunity that we have seen so far this year. So big picture, going back for the last 6 months, it has been a tough market earlier this year. And what's ahead of us that looks a lot more healthy and a lot more balanced than what we have seen in the last 6 months. So that's all I had for you. I hope that gave you a little bit of an idea what's going on in the Milwaukee real estate market. Thank you for watching, and I'll see you at the next one.